Every time your paycheck comes in, it feels like it should be enough. You worked. You showed up. You didn't waste money. And yet, within days, that paycheck feels smaller than expected. Bills stack up. The balance drops faster than you planned. And once again, it feels like the cost of living is quietly crushing your income. If this keeps happening, the first thing you need to hear is this. You're not imagining it. You're not failing because you're careless. In a moment, I'll explain the hidden reason this pressure keeps showing up, even for people who are being careful. Start with a normal month, not an extreme one. Your paycheck hits your account, and there's a short moment of relief, not excitement, just relief. Then the money starts leaving. Rent or the mortgage clears. The car payment follows. Insurance pulls automatically. Utilities fluctuate. Groceries cost more than last time, even though you bought the same things. Before you've had time to think, most of your income is already gone. Then something small happens. A medical copay, prescription, a higher than expected bill. A few $100s that wipes out whatever breathing room you thought you had. Now, you're not thinking about saving or progress. You're thinking about getting through the rest of the month. This cycle feels personal, but it's not. It's structural. In a moment, I'll explain why being careful alone doesn't fix this anymore. For a long time, cost of living and income move together. Not perfectly, but closely enough. Today, they don't. Housing costs take a much larger share of income. Transportation costs more. Insurance premiums rise quietly every year. Healthcare expenses appear without warning. Wages haven't kept pace with all of it. When most of your income is locked into fixed costs, flexibility disappears. Without flexibility, every small problem feels huge. This is why people feel constantly on edge. Not in crisis, but never relaxed. Always watching the account. Always hoping nothing unexpected happens. Budgeting helps you see the numbers, but it can't create margin when everything is already committed. You can be disciplined and still feel stuck. Now let's talk about the role credit plays here, because it's often misunderstood. Credit cards and loans don't just fund spending. They absorb rising costs. When groceries, rent, or medical bills increase faster than income, credit steps in to smooth the gap. At first, that feels helpful. But over time, that help becomes pressure. Most credit cards today carry interest rates in the 20 to 30% range. That interest doesn't show up loudly, quietly works in the background. Here's a simple example. If you carry a $3,000 balance at 24% interest, you're paying around $700 a year just in interest. That money doesn't reduce what you owe. It doesn't make life easier. It simply keeps you where you are. You can pay on time every month and still feel like your paycheck never stretches far enough. It's not because you're doing something wrong. It's how the system is designed. In a moment, I'll explain why this pressure often feels invisible until it becomes overwhelming. Now, add credit scores to the picture and things feel even more confusing. Your credit score isn't measuring effort. It's measuring risk. One of the biggest parts of that score is payment history, which makes up roughly 1/3 of the total. Paying on time matters because late payments signal instability, and even one late payment can hurt more than people expect. But here's the part most people aren't told. Payment history mostly protects you from damage. It doesn't automatically help your score grow if other risk factors stay high. Another major factor is credit utilization, which simply means how much of your available credit you're using. If you have a $10,000 credit limit and you're using $8,000, that's 80% utilization. Even with perfect payments, that signals risk. This is why people feel like they're doing everything right and still not getting ahead. In a few minutes, I'll explain why small changes here can matter more than months of effort. Now think about how people respond when the cost of living keeps squeezing them. They try to work more, extra shifts, side hours, overtime, and sometimes that helps briefly. But often, it doesn't solve the core problem. Why? Because fixed costs don't scale down, and small income increases are often absorbed by taxes, delayed expenses, or things you had to postpone. You work more, feel more tired, and still feel stuck. This is where people make choices that feel logical under pressure. They lean more on credit to avoid falling behind. They cut small expenses aggressively while ignoring larger structural costs. They delay looking closely at their finances because it feels overwhelming. None of this means you're bad with money. These are normal responses to pressure. But this is also where people accidentally make things worse. For example, many people focus only on paying bills on time and assume that's enough. Paying on time matters, but it doesn't reduce balances or interest. Others move balances around without reducing them. Some close accounts to feel in control, not realizing that can increase utilization in the short term. And many people chase fast money ideas because they feel desperate only to end up disappointed or burned. Later, I'll explain what actually helps instead, without hype or shortcuts. Before that, it's important to reframe what's happening. The cost of living crushing your paycheck isn't a sign that you failed. It's a sign that the financial system leaves very little margin. Margin doesn't mean wealth, it means breathing room, enough space that one unexpected expense doesn't knock everything over. Once you see that, the goal changes. It's no longer about trying harder. It's about creating margin slowly. Let's return to credit utilization for a moment, because this is where small shifts can have outsized effects. Imagine you have a $5,000 credit limit, and you're using $4,000. That's 80% utilization. If you reduce that balance to $3,500, your utilization drops to 70%. That one change can matter more than months of perfect payments. This is why progress often feels invisible until something finally shifts. Interest slows everything down, which makes patience harder. This combination is why the cost of living feels relentless. Your income covers survival, but not margin. Now let's talk about income in a realistic way. Being careful can only go so far when costs keep rising. At some point, income flexibility matters more than willpower. It doesn't mean chasing risky schemes or working nonstop. It means choosing slow, boring, predictable ways to bring in extra money. This is where boring income wins. Gig work works because it's flexible and immediate. Freelancing works because skills compound over time. Simple service-based work works because demand stays consistent. These options aren't exciting, but they're controllable. Fast money usually backfires because it relies on hype, timing, or luck. Slow money works because it's steady and predictable. You don't need a breakthrough, you need margin. Now let's slow this down and make it practical. Today, the goal isn't perfection, it's awareness. Look at where your money is already committed. Identify fixed costs. Notice which debts carry the highest interest. Avoid adding new balances if possible. That alone reduces mental pressure. This week, focus on protection. Automate minimum payments so nothing slips. Look for small ways to reduce utilization even slightly. Even a few $100s matters. This month, focus on margin. One realistic income move, one boring, predictable step that creates breathing room. That breathing room is what makes everything else easier. If the cost of living feels like it keeps crushing your paycheck, it doesn't mean you failed. It means modern financial life is tight, and no one explained it clearly. Financial repair is slow. It doesn't feel exciting, but it is possible. And once you understand what's really happening, you stop fighting yourself and start working with reality instead. There's more clarity ahead. We'll take it one piece at a time.